Well, welcome everybody to another week of discussing markets. And of course, what a couple of weeks we've had when it comes to the US election, volatility in crypto, big movements in currencies as well, with the dollar going up, now possibly switching. And we're just less than 24 hours away from probably the biggest stock giving us an earnings result, which is Nvidia. So a lot to go through today. Today, we'll be talking about simplifying your strategy. Why do we want to do that? Well, let's look at how effective some of the simplest concepts have been over the last couple of weeks. We'll be breaking that down on the charts and obviously then talking about what we're thinking is happening moving forward. My name's Thomas Atkinson. As always, I'm joined by Tyrone Abella from FX Evolution. How are you going, Ty?
Good, thanks, Tom, and welcome everybody. Yeah, look, it's been a really exciting couple of weeks, and I think we're touching today on one of my favorite indicators, that's for sure. Because really, simple is good, and when we can understand a simple concept and apply it to everyday markets, especially in the most volatile of periods that we've had over the last couple of weeks, I think people can really appreciate and understand how powerful they can be even in a normal market. So yeah, looking forward to applying it to today's trading and also what's happened over the last little bit.
So I guess what we'll do is we'll get started here with the S&P 500 because this is one that's going to be discussed a lot over the next 24 hours. And what you guys will notice is I've got it sitting on a daily chart. Now, we do like to look obviously monthly, weekly into the daily. And I just want to kind of reiterate here that Tyrone's 20 moving average, we'll call it Tyrone's 20 moving average because he likes it even more than I do, has been very, very good. It's what we call mean reversion. And what you'll notice is that we've seen this strong buy up that's occurred throughout 2024 off the weekly 20 moving average. So never lose sight of that, especially when you're looking at futures markets. And you'll notice that even when it got breached over here back in August, it quickly rallied to close above it. And that is often the key. It's not so much if it goes underneath the moving average, does it hold the moving average? Does it close below or does it actually just rebound and close above or close around the same price? That's very important to always state whenever you're looking at these things. If it manages to hold above and close above, that's not a valid break towards the downside, is it, Ty?
No, it's not. No, it's not. And really, it is about absolutely where it closes. And I think you can see some really good examples here, even on the weekly. I mean, there's an amazing morning star there that we could actually see. Obviously, it's probably a really good example of what Tom's talking about, that it really tried to push through, but where it closed was actually above the 20 moving average. And that really started, that was the catalyst for that next big move. So I think that understanding the trend is really, really important. Look, we're all aware, and it's probably, if you're not aware, it's very important to understand that if a market's going sideways and flat, moving averages become very, very useless in the form of support or resistance that they give. But when we've got a big established trend like the S&P 500 has been in, I mean, a weekly is a no-nonsense chart. Every one of these candles represents a week's worth of trading. So when you're seeing series of higher highs and higher lows bouncing off a 20 moving average like this, and it being ultimately respected, it's very easy for you to take advantage of that. And I think probably, Tom, moving averages, when you're looking at it on a weekly chart like that, for not just traders or day traders, but also for investors, like who are actually looking at repositioning their portfolios. Like, you don't have to be a day trader and be in and out of the markets every couple of days to really benefit from a moving average like this on a big time frame, because they were perfect reload zones for your portfolio. But probably just as importantly, rebalancing when they do hit a form of resistance if it is actually going in the other direction.
Yeah, and I think the key here is also that you've just got to realize that moving averages can be used on all time frames. It's not just one; it's all of them across the board. But yeah, investing weekly 20 is one of the best. So let's just break this down to the daily for a second here, because what we're doing today is we're breaking down moving averages with anchored VWAP. And what I've noticed in recent times is, of course, what we've been using anchored VWAP for quite some time, is that we've got some pretty good levels that have been approached over the last kind of months. So first up, what I like to do, and I'll get rid of these so you can see them. So basically, we'll delete these anchored VWAPs. And of course, if you want to get access to the anchored VWAP, by the way, as a tool, then you can connect your Pepperstone trading platform with TradingView, and you'll be able to get this. So what I'm doing is I'm dropping them behind the lows. So usually with anchored VWAP, the best way to do it is to drop it behind the lows and the highs, the highest highs and the lowest lows, and then to plan that one out into the future. So what I would usually do is, as we see a trend on the way up, I would actually drop a bunch of anchored VWAPs. Now, like any technique, you're wanting to use a mixture of a few different reasons to potentially buy or sell positions. But here we're doing it on the daily, and this can give us a lot of insight into the smaller time frames. So what you'll notice is we've got one down here in the lower low formed in September, and then we've dropped that. And the first time that hit was over here during the sell-off in November, around that, of course, election period. And what we'll notice is it held up that zone. So first up, this anchored VWAP, the first touch was pretty good. And I do tend to find the first touch is one of the best trading concepts. So here we've got one off this low. It touches it over here. We obviously see a bounce that comes off this price. It then holds around that price and then ends up rallying back up. Then we put one behind this low here, and you can see that it does respect that, at least initially. So as a day trader, never discount having the lows, specifically on indices as well, connected. So you always want to do this with every single low point that you've seen. Now, the reason I mention this, and I'll get rid of some of these so we're not confused anymore by how many squiggly lines there are, is I want to add one to the low over here that was formed during the 31st of October. Now, what you'll notice is that anchored VWAP has connected itself to the daily 20 moving average. And this is just a simple moving average, by the way. So it's an SMA. I've seen a lot of studies on this. Obviously, we like EMAs and SMAs. We like both of them. The 20 is one of those ones that's up for contention. Which one do you use? But either or, they give you pretty similar levels. And in general, you'll notice here what happens is we get an overlap with the anchored VWAP. So that's the A VWAP connects with roll reversal. So that's resistance becomes support. It's pretty good, isn't it, Ty? That's nice. So we've got roll reversal. We've got A VWAP. Absolutely. And we've got the daily 20 moving average. And you'll notice here that we've seen that respected several times throughout the sells and the buys in recent times. So this gives us just three separated reasons why we probably will want to see a bid around this price. And what we saw over the last 24 hours was a very strong movement. It went down and then it rejected in a big way. And what type of candle is this, Ty, for everyone out there? It's a pretty good one, isn't it, to come off the lows?
Oh, absolutely. I mean, it's showing a big change in bias and seller momentum, with the end of the candle being very, very positive. I mean, look, that's three significant reasons why that level is solid. I mean, look, you probably throw in a Fibonacci retracement there. You can bet your bottom dollar is probably somewhere around the 50 fib mark as well. So, realistically, look, it's building a case for the, basically giving the direction something to bounce off. Like, you're not guessing here. You're getting, you're getting about 4 or 5 different reasons to trade off a particular level, where traders from around the world and institutions from around the world are actually seeing different things just like you are, and you're basing it all together. So it's not like you've got price action too. Let's not forget, but the most important indicator of them all, price action, which is actually the first one. That's actually the leading indicator of them all, and it's the one actually giving you a signal too. So we've already just labeled 6 signals there that there's a reason why you would be looking at that zone. And I think that when you start applying these rules to your trading, you're going to notice a very significant change in the amount of times you're going to get it right. And I think that moving averages and VWAPs are very, very market adaptive, and I think they can't be underestimated. A lot of people, Tom, I find, discount the moving average and say, well, everyone's got a moving average on their chart. It doesn't really mean anything. It looks good in hindsight. I think we could show you reasons every day on our streams that it's actually not hindsight. The moving average is an extraordinarily important tool in the live charts all the time. So never discount it just because it seems simple. It's a very, very powerful concept, especially the 20. I'm a big advocate for the 20, as everybody knows here.
I want to read a quote actually we got on our YouTube today from a gentleman, because I was talking about how technical analysis certainly is not reading tarot cards. A lot of people think that technical analysis is tarot card reading and all this other stuff, but really it's the trading of human psychology. Now, if we look at something like the moving averages, as Tyrone was saying, the 20 moving average in particular is basically a calendar month of trading. So you've got to realize that actually in itself is why it's the best, because it's based on that idea that months mean something to us as humans, and therefore it has this relevance to us, especially on the daily. But I want to read this. So this is a comment from, it's a little bit of a long one, but I'll read it anyway. So love your comment. It's not tarot cards. I've been trading for 30 plus years, so some experience here. And I was lucky enough to meet and speak with Wells Wilder, who developed the RSI back in the early 90s. He said exactly what you said in the charts, and that they are representations of human psychology. He also said he asks a child for the direction of trend after showing them a chart, and they will tell you the obvious. Obviously, children tend not to lie. Greed and fear stuff up our viewpoints for adults oftentimes. And that's the information overload that we get, especially now since mobile phones. So I thought that was a great comment, because that's what these simple indicators are. If they make sense to, being based on human psychology and therefore giving you an edge on maybe what people are thinking, and often possibly the counter to that, then you'll actually do a lot better. And in this case, anchored VWAP, as Tyrone mentioned, is market adaptive. Moving averages are marketing adaptive. And when we're looking at price action changes, they are market adaptive. And all of those are very key. It's when you've got these static systems that you tend to get bashed around a lot more. So let's break down this US 500 a little bit more, because Tyrone mentioned we had, of course, price action coming in our way. So what happens is we get this steady down kind of trend line. And then, of course, we get the market going to a new lower low. And then during the last session, it made a higher high over here, which to me is the first sign of pretty good strength. And then by the end of the session, it had made a higher high over all of the structure. And when I see that, although it's not absolutely guaranteed, but along with the other things, that gives us a lot more edge to think that even if this market does pull back now, Ty, there's a decent chance that there are actually bidders that could be looking to get into this position.
Absolutely. I think when it sets up like this, I tend to get a little bit more excited, actually, because I know that you've got a fallback plan, even if it does come back. And I think that, look, you've heard, and if you haven't heard of our scaling videos that we've done with Pepperstone, certainly check out the Pepperstone YouTube channel, where we've got many, many topics that we've done over the years. One of them is scaling in and scaling out of trades. And this is probably one of those examples where if you are a little bit unsure on the base, actually scaling into a trade like this and leaving some backup, some dry powder, if you like, for if it does pull back to what is definitely a potential support zone that it's going to pick up momentum from that level, you often get into a better quality of trade. So you don't need to be all in. It's not sometimes the setups are that good that you can be a little bit more bullish, but I think that when you've got the opportunity to use these indicators to your advantage and have a fallback plan as well, which I think is really important. I think that's why the VWAP actually really comes into its own, because it is a little bit of a fallback plan for where you can re-add to a position if we do get a little bit of weakness. Because a little bit of weakness doesn't mean it's selling off. A little bit of weakness means that it can sometimes just be rebuilding its strength, and then the momentum from that level will be the one that really takes it to the promised land.
So let's step that through again from everybody's perspective here. So there are a few things that we just want to nuance here. The first one is that we have the low down here, which hits in at around this price. We get two rejection candles or long leg dojis. They are then price proofed by this bullish candle here to basically say, okay, we're probably bullish. This also happens, or just so happens, at a point of support. So other support traders are in. So again, we've got anchored VWAP here. We don't have, in this case, 20 moving average. I can tell you we do have a 50 SMA at this level. Okay, so there's a 50 SMA there. We've got a demand structure, and we've also got a support structure based on support resistance. Okay, so this is multiple different reasons coupled with ultimately price action, which is basically telling you that yes, you are most likely correct about that level being important. Because remember, it's not just finding the level, it's then having the patience to see the reaction to that level. So when we say patience, react, don't predict, what we're really saying is find the level, wait for the level to be hit, wait for the level to be reacted to from market money, because we need to see the algorithms, we need to see the biggest funds in the world actually having a go at that level, and then entering the trigger. And therefore, we're not really predicting. Instead, we're having patience to look for the key zone, and then we're reacting to the biggest flows moving in. And that, in essence, is a change in psychology. So you'll notice that Tyrone said before, what did we see? We see price action. We see that people, that big bullish hammer over here could represent, or at least statistically may represent, a change in psychology. Somebody has said, you know what, that's pretty cheap. I'm pretty excited, and therefore I'm going to push it up. So what a great breakdown. Not complicated stuff, but most people
No.
don't understand.
Yeah, and I think it's really, I think patience is the word there that probably makes the most amount of, I guess, sense for a trader. It's probably the hardest for them to understand. Like it's like anything. You don't want to be the first person to the party. You want to be at the party when everybody's swinging, everybody's on board. And I think that's what patience comes down to. A lot of people think that traders will set a level and say, okay, if price gets to that level, I'm in. But trading's not really about that. But you need to get it to that level and then wait and be patient enough to understand that level is going to be respected, and the price action kicks in and starts to prove your concept. And when it does that, that's the patience component. When you see, you don't have to get every single pip or every single point of that move. You want the quality portion of that move. So it's better to let other people, other traders, speculators actually kick the momentum on, and then once that momentum is going, then you jump in and your trade. If you apply that simple theory of just waiting and being a little bit more patient at a good setup, I think you'll find it'll make a big difference to the quality of trade that you're placing, because you're using momentum and price action as a trigger point rather than just the support itself.
So let's move over to another example here of what we would do if we were setting up a chart. Now, I haven't pre-prepped this or anything. I'm just kind of just showing you what I would generally do. So whenever I'm looking at these types of markets, I would usually put anchored VWAPs behind several of the lows. So in this case, we're going to move over to ZAG USD so that we can get real volume on the market. So we can use anchored VWAPs. And we've got just a 20 moving average sitting on the chart. So we'll drop a couple down. So we're going to drop one below here. Okay. We're going to drop another one over in this area over here with the low there. So you can see the reaction for the first time. And what this is telling you is that, again, I would just keep dropping these as I was going behind, and I would keep placing or considering placing day trades based on these particular anchored VWAPs. So if you actually look, this one here that we place here gets some form of reaction off here. That could be something we could scalp on to the day upside. I'm sure if we place one behind there, it's probably going to show here, which means we could scalp to the upside. Remember, it's the first touch that's the key. And I think a lot of people miss this with anchored VWAP. So we've got one from the low. We've got one from this low over here. And of course, this is now a considerable low. So this is actually the lowest low of price. So the highest high and the lowest low, so this would be the highest high now, often weight the best in terms of anchored VWAP. So what you'll notice is we get some reactions. We go a little bit lower. We see that first reaction there, which is really nice. We see this create a consolidation zone. And guess what? Recently, we've seen this original lower low get reacted to. So all of these anchored VWAPs would be worth having on the charts. And of course, we would also want to look at the weekly 20. We can see where the weekly 20 is. So it's around this price. And we would want to break down our knowledge of demand and supply structures. So if we look at a support here, we'll notice that this is a support, most likely a demand area. We see a reaction, because remember, we're looking for these reaction points off this price. So once we start to see those, we can start to couple in some other basic technical theories. So another basic technical theory is, of course, trend lines. And while I'm not a huge trend line fan, I don't think I think everybody can see this one, Ty. It's not that difficult, and that's a fairly good trend line, isn't it? In terms of it's quite well proofed.
Yeah, I think one of the biggest knocks on trend lines, I think, is the fact that the subjectivity of them. People draw a lot of lines and they don't really understand them. Like, in our Ultimate Trading Masterclass, we absolutely break down the rules. And if you follow those rules to the letter for trend lines, you can have a great deal of success with trend lines. But not many people do, unfortunately. And I think that's where, like a lot of chart patterns, actually, when they're not traded in their optimum environment, Tom, they're going to let you down a little bit more than you would like. So I think if you're going to use trend lines, understand why you're using it and understand if it's a quality one or not. I think a validated trend line is what we like to use the term of. So, but some of them are just that obvious that you have to put them on, and that was certainly one of them.
Yeah, that was one of them. There's actually a lot on silver. So the reason I state all of this is because what we're starting to do is, again, it looks like there's a lot of lines. So some of the ones that we we'd remove at this point because they've already been used. This one would be gone. The one from this low down here, because it already broke to the downside, that would be removed. And we'd probably just have this one and the ones from the top, that is the highest high and this high here, maybe even these highs on the way down. Now, you'll notice here we've also got this trend line on the downside, series of lower lows and lower highs, and ultimately price action is the most important. So what we saw was the market actually close above this downward trend line just over here. And when that happened, some trends changed. We saw a large wick candle come through on that daily time frame. We saw the anchored VWAP hold. We saw the demand structure hold. It was a good first sign for a scalper or day trader that this is actually going to find a bid. And maybe the downward trend is now over for now, and we're going to start seeing bullishness. And just like that, we start to see bullishness. Now, Ty, if we do start to see a rally to the upside, what could be a good moving average for us to target, and more importantly, to start seeing potential resistance at least temporarily?
Yeah, look, I mean, depending on where the moving average is, obviously the 20 and the 50 are always going to be an important marker, depending on how much it's sold off. But then we've got
There
look,
it is.
one of our favorite
So
moving averages. Yeah, it's right there. It's always there. It's always there where you need it to be. And I think that
so
that's why it's on all of our charts. I think if you're avid followers of both Thomas and myself and all of the Pepperstone videos that we do, we've always got a moving average on, and that moving average, the red one is always going to be a 20, and the blue one's always going to be a 50. They're the color that we've used for the best part of 15 years now, and they're there because we use them. Okay, they're not there just for. We want to keep the charts as minimalistic as possible. It's very, very important to understand everything that's on that chart. You need to know why it's there. And I think, look, we've seen many charts, Tom and I, from people that we've coached or mentored, that there's been so many lines and indicators and craziness on the chart that you couldn't even see price itself. There were so many things there. So it's very, very important to keep your charts at a level where you understand every single thing that's on that chart and why it's there. And I think and that's why it can be very overwhelming when you look at what, say, Tom is doing right now. But hopefully this explanation that we've just given you tells you why every one of those lines is there and why they're very, very important, because they're not just important for a reload zone to actually enter a trade. They're just as important for an exit of a trade, like we just discussed there as a resistance point.
Yeah, correct. And it kind of starts to present the way that we would approach it. So obviously we say that we've got the high ones, which we've put in. We've obviously got the low ones, and we're starting to trap price between take profit zones and potential entry zones. Now, I think that silver's made a fairly decent turn, by the way. I think that the chances are that pullbacks will be met by bull demand ultimately. But where was the most likely first take profit? Where was the most likely resistance? It was going to be this one, because we've got an anchored VWAP, we have a daily 20 moving average, and ultimately it also comes down to price action as well. And it just so happens that we have a supply over here, which led into a pretty big sell. It obviously made a lower low. So you can see this is the supply, that's the reaction to the supply. And at the moment, if you had to ask me, I would say it's in a short-term downtrend with the possibility of this anchored VWAP here or this demand structure starting to find buyers once again. So again, it's just building the confluence storyline. That's what we've got to do. Build the confluence storyline, find the area, see the reaction, trade the reaction. Don't just sit there and say, oh, all these anchored VWAPs are great, because sometimes you're going to hit an anchored VWAP, it's just going to melt it like butter, or it's going to move a moving average and just go straight through it. It's about saying, do I have enough other reasons? Usually you're using about 3 to maybe 5 different separate reasons, maybe even 4 to 7 separate reasons that are all separated to get into a position. So let's now move over to another one. And I guess at the moment, something that's pretty popular has been, I guess we'll go actually US dollar just for a moment here, just have a look at this, because the US dollar has been an aggressive upward trend. And you'll notice here that it's only really had one significant pullback, daily 20 moving average plus a support line. And I've got an anchored VWAP down here. This is using the US dollar index futures. And you'll notice again, downward trend line is breached. Market has changed trend. Market blitzes up, finds first resistance over here, goes back down a little bit. Daily 20 holds it. No anchored VWAP touch there. What would I do? I would add an anchored VWAP here. And if the market does come down to this level, what could we see coinciding with each other? By the time it gets here, maybe the daily 20s come up. Anchored VWAP at the same level, all of a sudden, you might have a confluence storyline for you as a day trader or scalper. And that can be really, really good. And you'll notice that we haven't changed over the years. If you've been watching us 5, 6, 7, 8 years ago, what we're doing is we're always using a higher time frame to find smaller time frame trades. And you might say, well, I want to trade a 5-minute chart. This is actually how you trade 5-minute charts. You do it from a higher time frame. Why? We're trading the psychology of the market. If you look at a big funds don't enter on 5-minute transactions. They enter as a overall order size, and it's like a position. Yeah. So you've got to think of it as this is the position. They like the price. They like the price more. If they're buying, they really love the price. And then when it goes under that, they buy everything they can to try to push it up. And that's what creates those wicks. And I always like to say wicks hold orders, because wicks hold excitement of the market. So think about every single thing you've ever learned in technical analysis, or every other thing that you've ever learned in instruments or anything else, as psychology. That's all it is. What are the orders doing? And once you start breaking it down this way, it becomes easier to spot that confluence and to put yourself in the shoes of a larger fund. I feel like that's where people really get it wrong. They just think 1 minute, 2-minute charts. Who cares about the funds? You've got to think about flow to gain edge.
Absolutely. And I think the dollar index, look, the dollar index has been a fantastic trade. Look, there's no matter which way you look at it, since late September, when it was really actually forming that bottom, there was a very, very strong possibility that it was going to actually reverse off that. If it was in a downtrend, there was no question about that, and a very solid downtrend at that. But on the daily, you can see that there's divergence everywhere. There's 3 different indicators that you could have put divergence on when it was around that 100 zone. Very, very powerful. And when you saw that movement, look, I think Tom's going to give us a MACD divergence. It's gonna, that's my favorite divergence indicator. That is absolute classic, class A bullish divergence right there. And it's coupled with a wide bottom, trough, and what that's telling us is that the market's seriously considering that level and respecting that 100 number. So that was, the chances of it turning around were extraordinary, and turn around it certainly did. But I think, yes, we've got this signal. We know that there's a very big chance that we're going to see a very, very big long move. But I can tell you, you can go to any time frame underneath the daily on the dollar index, or for the opposite, trade the euro on the way down, and you will have no less than probably 30 or 40 quality entries in the direction of that big trend reversal that you would have been able to take advantage of over the last probably 5 to 6 weeks. Absolutely, they're there everywhere. And even though it looks aggressive, even though it looks like it's been a massive move, it's been extraordinarily tradable just by applying the rules that we've talked about today.
Yes, this is a classic 1-2 MA system. So remember, if you're ever going to use an MA just to buy off, always proof it by seeing the MA respected at least twice in that trend. So you've got respect, higher high, respect. It's still good. Probably burns a little bit here, but doesn't make a lower low, which means it's still good. Respect, it's off the screen at this point, but it's still going, and it dies around here. So basically, this is where the trend, that particular trend, stops. But as Tyron said, once it goes back onto the next trend, again, it finds a moving average and it goes up off it. So what I think is a really good idea is anchored VWAP gives you a great swing entry often. Moving averages can give you those really good dynamic support or resistances in aggressive trends. And we are starting to see, the line of very aggressive trends. I mean, not that this is something you're probably going to trade on the Pepperstone platform. It's quite risky, obviously moving at a ballistic rate. But this is just another classic case of something that's gone at such a speed that the only real way of getting into it has been to use probably like a 4-hour 20. And you can see here, I'll just use the 1-2 system to give you an example. So 1, 2, 3, enter, and it's gone to the stratosphere at this stage. And you can see here it hasn't even bothered coming back anymore because it just keeps going. But that's really the way you would have gotten it, because you see the replication, you see the aggression of the trend. So difficult for most technical analysts to get into these, isn't it, Ty? And the moving average is an exceptional way to consider that.
Absolutely. There's not too many trends that you'll find that won't give you entries on smaller time frames in that direction if you're patient enough to wait for the pullback to a quality level at the 20 moving average. And it's such a universal moving average as well. Like I say, you can go to a 4 hour, you can go to a 2 hour, you can go to a 1 hour, depending on how you're trading. I mean, if you're trading intra-session, you can go as low as 15 minutes, and you're going to be able to get pullbacks in the direction for that session. So, but the key is, and I think it's really important to understand this, the key is to ensure that you are looking at the bigger time frames, even though you're not trading off the daily or you're not trading off the weekly. It's extraordinarily important to understand which direction those big time frames are going to give you that edge in the smaller time frames to be able to trade in the direction of the prevailing trend. It's very, very important. I know we say it a lot, but we say it a lot because it's extraordinarily important.
A few weeks ago, we did a session on coiling and how a market does, a sideways action for a while, and that has like pent up demands, what we call a pit or a pullback in time. Just remember, when a market breaks out from a pit, these are the points where generally these anchored VWAPs and moving average strategies come in, because markets will often, when they sit for this long, they waste time. Time is the most important asset really in the markets. So when you get a breakout from a time, it can often feed upon itself. And these are where you get these really aggressive moves. So even with that US dollar, Ty said before, it was forming a strong base. That base took a while, didn't it, Ty? So by the time that base had broken out, it had been sitting down there for like 1.5 months. Then it breaks to the upside. All of a sudden, you've had a pullback in time. You've wasted time. It's time for an aggressive move. So remember, a coil or a channel or whatever the hell you want to call it, demand or accumulation or whichever technical analysis term you want to use on it, what that really is going to tell you is when it breaks out from those big coils, often the trend is more aggressive. And that means that you must start to think about moving averages and anchored VWAPs in your strategies to get into these particular momentum style trades. Because where are you going to see momentum? A break of a pullback in time or a strong consolidation zone. So Bitcoin's been the same thing. It was a 2 hour 20, and now at the moment it's been a 4 hour 20. But I guess I always say this to people, like I've got a lot of signs saying that Bitcoin's a little bit expensive right now from the short term time frame. But I certainly wouldn't be selling that, because this market is what we call dull. And it's dull and it's making a series of higher highs and higher lows. Do you go against a trend like this, Ty?
Absolutely not. And especially in a commodity like Bitcoin that can really realistically go to any level. I mean, it's not like oil or gold that there is actually an end point as to supply. This is not limited by the supply constraints of gold and oil. This could go to 100,000 and people probably wouldn't even blink. It could be there tomorrow. Like we've seen some very, very big moves on it. But I think the important part of Bitcoin was we were talking about it for several weeks before it actually broke out, Tom, that, when it does break out, it's going to be scary. And it certainly was that.
Really good.
But yeah, absolutely. And I think that the important part is, although it looks untradeable in the way that it's gone up, you only have to go to the smaller time frames to identify extraordinarily consistent opportunities to get in. Talking about the most simple things that we've talked about today, to just follow the trend, know that you wouldn't trade against this trend, right? Like even when it does eventually turn around, I would be letting it, probably sell off quite a bit before I'd be getting involved in it, because this is extraordinarily aggressive. And look, it wasn't like we weren't warned. I mean, I know we were talking about this, Tom, in the live events that we did with Pepperstone, and I know Chris Weston was very heavily involved in what he thought about Bitcoin, especially if the red wave got elected, and it certainly did, and it played the role beautifully. But I think, in the context of what we're looking at here, the dollar index did the same thing. Like we're not as explosive and maybe not as exaggerated, but both of them moved in the exact same direction at the exact time. So it was. Not that I'm saying that the two are correlated, but both of them have moved, very, very comfortably and given us opportunities to actually trade it in a safe manner. And I think that's the important part. Not trying to jump on a storm that could end at any time, or we want to take luck out of the equation, I think is what we're trying to say. We want to take luck absolutely out of any equation in picking a direction. We want to be able to establish a direction and trade in that direction in a safe manner, following stringent rules. And that's what trading really is about.
Yeah, stringent rules, essential. Treat it like a business. Don't treat it like some kind of weird gambling or I think it's going to do this, or hope is the worst.
Hope is not the
We don't
word.
use hope.
If you're using the word hope,
Yeah,
time to close that
yeah,
position. Damn.
yeah.
Get
It's
out. Get
not good.
out
I
quick.
hope I hope it comes back is not really the greatest thing to ever say, but I'm sure a lot of anyone else out there in the chat had that one done to them. They would thought, I hope it
I
comes
think,
back.
yeah,
And
I hope it comes back, or surely it can't go any further. I
oh
think
yeah, surely it can't go any higher.
yeah,
That's the
it can't go
classic.
any lower than that, or it can't go any higher
Yeah.
than that. Uh
Let's
huh.
let's go over to the Australian market for a second, just to show again thought processes of how you could apply these. Now, I've got a lot of red arrows, and you're probably going to see why. Uh, let's get them realigned there. And what you're going to notice here is it's all about the weekly 20 moving average. I just want to show again the 20 is quite powerful. And for anyone that's a new viewer out there, welcome firstly. Make sure to sub. Links in the description down below if you want to come and join these live, because we do these each week. But you'll notice here that this 20 weekly moving average has just been respected the entirety of 2024. Again, even better in many ways than the US market. And what we then saw was we saw strong reactions off the lows. So just like anything, what I would always do is I would come into these levels and I would be drawing up my anchored VWAPs. And what you'll notice is that we had a lot of respect at the anchored VWAP on the way up. We broke that respect. We went to the second one, just so happens to be a 20 weekly moving average as well. We see the first one react off here. We see the second one react off here. And we would just do the same thing time and time again. So once you've got this low inside of the market, what we would have done is taken a low off here and then use that potentially as day traders on the way up. It's a great strategy to build confluence with other things. Don't use anchored VWAP by itself. Don't use a moving average by itself. But when you have a replication of a couple of things together, so we'll just quickly fix that anchored VWAP because I knew it'd be wrong. When you have them a few things together, then it can be very, very powerful for creating that synergy or that strategy story. So we saw it on the S&P. We saw it on obviously silver in particular. We can see it here a little bit on the Aussie 200. We see that the moving average in particular has been very good on Bitcoin. Anchored VWAP's been good there as well. US dollar's been very strong, a myriad of different techniques. I'd always like to ask you guys out there that are watching right now, do you have any questions for Tyrone and I about moving averages, about anchored VWAPs and how to use them, or any other things? So just feel free to ask that right now if you're here live, and we'll answer those. While we're waiting for those answers, Ty, or those questions, Ty, let's jump on over to another favorite, which is obviously a currency. So we'll go here to the odd US dollar currency, and we'll load that one up. So I already put an anchored VWAP off the top, and I just want to kind of show you why we've seen a little bit of resistance here. So you can see the anchored VWAP off the top. So that's on the anchored VWAP will obviously split across all of the time frames, so it's not going to care about daily or anything because it's based on price. But you can see here the respect that is put on that. And what we would do again in this situation is you would have one that you placed up here in the highs, and you can see again it gets close into that price, finds resistance. So what have we seen on the Aussie? Well, if we go out to higher time frames, we've seen a decent amount of buying previously around this price. It's shorted very heavily into here. One of the anchored VWAPs and the weekly 20 moving average coincided with each other over here. So you know that's an excellent, if you're buying, sell price. And if you're selling, look for a turn here. That would be an excellent day trade opportunity and scalp opportunity, which is going to get you that larger evidence-based approach. Let's actually just look at this one together. I'm just going to go up here to this price. So this is where you would have seen all of those coinciding with each other. And as you scroll in smaller time frames, okay, here we go. As you scroll in higher time frames, what you'll notice is the market kind of goes high, low, higher high, equal low, lower high, lower low. And once that occurs, it's kind of saying, you know what? All of your respect up here, the weekly 20 moving average, the anchored VWAP off the top, the supply on the other side, they've been reacted to. And that's kind of a go signal in here for a scalper to go short. And that's just using multiple time frames. And you might say, but But Tom, you've cherry-picked the level. Not really, because again, it's multitude of different confluence. And we've seen something similar to that in the S&P as well. I think we've got a question coming through, Ty, and that question is, can you use this on anything? The answer is generally yes. The daily 20 moving average and weekly 20 moving average in particular, I would say are incredibly strong. The 1-2 system, I've tested it on most asset classes. Ty, do you have any asset classes you think it doesn't work on?
No, I think well, I know the moving average, I'm very comfortable with that on any chart, even volatile ones and ones that have got low volume. It doesn't seem to really fail. Look, it can sometimes be a little bit slower when you see explosive moves, but there's not too many time frames that you wouldn't be able to go down and drill into that you would actually get a reaction off them. It's really about finding the right time frame that you can actually take advantage of.
So I would say also you want liquid pairs. So if you're going to use anchored VWAP in particular, you're going to want liquidity. So you want probably large size if you can. So as large as possible. The bigger the better. The more liquid, the better it is. So yeah, I guess if you're using both, then I would say highly liquid pairs would be best. Things like gold, things like big currencies, things like big indices, they'll be the best ones. More of those random softs and stuff, that's where you could get in a little bit of trouble. But just remember the 20 moving average is based on the last 20 periods of whatever time frame you're on. So it should really always be relevant and market adaptive. So if you're going to get a couple of things out of today, thank you very much for that question. What I would say is keep things simple. Start with the basics. Remember, price action ultimately is your activation step. What you're doing with these indicators is building a level of confluence. Once you've found that confluence, have the patience to see the reaction to the confluence. This will change the game. I would print this as a tattoo on myself almost. Not that I'll do that, but I almost would, from the perspective of why it's so important. I think that we've trained a lot of people. The ones that are successful are the ones that actually are able to control their own emotions. It's one of the most difficult things in trading. You'll often see people getting super hyped about stuff. We're dealing with money. We're dealing with often significant money that you've worked hard for, and you've got to treat it like a business. Would you really go and buy a bunch of, let's say you have a cafe, would you really think about what you're going to buy before you buy, your new coffee machine for that? Of course, you'd go and do some research, yeah? You've got to do the research, and these indicators and waiting for the reaction is like something being on sale. So a good sale, 50% off. Ty, do you have any words of wisdom to leave everybody with today?
Only that I think it's really, really important that you understand the bigger time frames. I know we hype on about it a little bit, but I think understanding where the bigger time frames are in relation to the direction that you're planning on trading on the smaller ones is vital to use moving average as well. And I think that's probably the key. Understanding where the prevailing trend is will be an extraordinary advantage when you start applying moving averages to your smaller time frame trades.
Just a couple of questions here. One coming from Calvin. Can you have a look at gold? So gold, weekly 20 moving average, obviously sitting on a couple of different VWAPs that have come off different lows. So starting to get a little bit of confluence there. And on top of that, you've also got some daily kind of demand zones. So gold's doing well. You will notice that if we start to use anchored VWAP off the top, which we can do here, that you're starting to get into the territory of wondering whether there's a little bit of confluence that's going to start building between 2650 and 2667. If you're going to see selling, that could be a level of concern. But overall, I would say it's getting a decent amount of bid. And yeah, price action. Silver, I think, has probably the stronger setup, and then gold is just going to be basically moving with this. The good sign for gold is it made a higher high off this. So it was making a series of lower lows and lower highs, and it breached that to the upside. All right, guys. Well, thank you so much for following along. Make sure to sign up if you're watching this in replay. Links in the description down below. We'd love to see you next week as we cover the markets around the world and another topic of popularity in terms of different market techniques. From everyone here at Pepperstone, we want to say have a great week and good luck out there in the markets. And it looks like 2025 and the end of 2024 are going to be great times for us as traders. I don't think vol's going to drop, especially now we have Trump and potentially the tweets. So we'll see how that ends up playing out. I remember from 16 to 20, it could move like this.
Yeah, most definitely. Thanks so much, everybody, and we look forward to seeing you all next week.
All right. Thank you so much. Bye for now, guys.